Hey traders, welcome to Charts and Coffee. Hope everyone's having a good Tuesday morning. We're taking a look at the last trading day of the month. And one of the things that I talked about in Top Tier Outlook this week was frankly something that I probably underestimated, because this is something that goes on every year in the month of October. And that is that certain mutual funds have a year end in October, which means before we have the broader window dressing, tax loss harvesting phenomena of December, there is another one, not of the same size, but certainly it has been impactful. We have something like that in October. And I have a bigger breakdown of that's going to get posted to Countdown Trader today. So if you haven't already checked out Countdown Trader, you can check that update there later on. And I step into a little bit more detail. But suffice to say, if we are looking at the economic events on a calendar, right, this would be a little bit different than that. For example, today, we've got some employment cost index numbers, Chicago PMI, consumer board, consumer confidence number. And all of this really is just almost negligible going into tomorrow's ADP jolts and then Fed funds rate, FOMC statement, FOMC presser. So today is really going to be what's going to happen tomorrow, and then even what's going to happen Thursday with Apple earnings, right? So we have a lot going on in terms of those scheduled events. Of course, there are many events of the unscheduled variety going on as well, but these are the things that we know we're going to have to contend with. And that October phenomena is another one of them. So taking a look at what we've got on the indices this morning. And as always, if you have any questions, feel free to type them in. And let's jump on over to, I got to tell you, I want to start with crude, because crude has been one of those symbols that has been extremely volatile. And it's probably one of the best examples of why October has been as challenging as it's been. And it's not that we're not seeing small windows of opportunity. It's not that we're not seeing small windows of follow through. It's just that those windows don't last 2-3 days a week. And if they do, the broader path from, say, a high to a low is full of so much volatility. Remember, gang, trading is not about getting to a target. You might say, Rog, isn't that what trading's all about? Not really. Trading is not about getting to a target. Trading is the journey to the target. And sometimes the journey is untenable. Sometimes the risk involved with getting there just doesn't allow for the trade to stay. It reminds me of The Big Short. Who's seen that movie, right? Or read the book. The book is actually really good. So if you read that Michael Lewis book and then you watch the movie, you know that, we celebrate those traders who were able to hang on to that Big Short. We saw all the drama and the difficulty with maintaining that position, especially Burry's position. But what we don't, in the book that really should have been written, is not celebrating those traders who go all in and risk pretty much a lot of the account, risk ruin for this great payout. The lesson of that movie was awful from a trading perspective. The book that would have been responsible to write would have been The Road, the roadside, the roadkill, right? That littered the path to that sell-off. A lot of folks couldn't lock their investors out. A lot of folks could not handle keeping the position open until it finally and eventually imploded, right? The real estate market. And that's the book that should have been written. Because instead what we've done is we're celebrating top picking. We're celebrating massive target fixation and risking everything to make the big dollars. And that really has, in many ways, sadly, permeated trading land to the point where people think that's what trading is, right? Adding and defending and just hanging on there because we know this is going to happen. What if it didn't, right? So, that's stuff I think about. And if you're wondering why is there a parallel to that here? Because in hindsight, it looks pretty normal that, oh gosh, Rog, if we just would have sold October and hung in there, that would have been really easy. And I'll tell you this right now, it wasn't. Right? It just simply wasn't. The reason tax loss harvesting is happening is because funds, the smart guys, I say smart extremely facetiously, the smart guys lost money. So they're going to take the losses to offset the capital gains in other positions. That's why as we go into December, see, October is a bit of a microcosm to what we'll see in December. And one of the things that we'll see at the moment is sort of a glimpse into what we could be seeing even more so, more pronounced, larger in December. And that's that whole window dressing, tax loss harvesting, or more distilled to just basic directional understanding. The strength gets stronger, weak gets weaker. And that's it. That's how the year typically ends. All right. So with that being said, let's go ahead and jump into the questions as always. All right, here we go. I'm going to open up this daily time frame a little bit more, but I do love keeping that 5-minute and that hourly time frame visible because these 3 time frames are what I use to make the decisions that I'm going to make in the futures room and the sector secrets mastery room. We're going to look at short-term swings, longer-term swings, and of course, our day trading. All right. So with that in mind, Randy asks, IWM. Yeah, great question, Randy. I've got the RTY up right now. That's the futures version of it. This is the more 24-hour, almost 24-hour version. RTY is going to be one of those places where if we're going to continue to see a lot more pressure, this is going to be one of those corners of the market along with KRE. 3 out of the 4 indices. So if I've got NASDAQ, S&P, Dow, Russell, 3 out of 4 are in downtrends. The only index that's not in a downtrend, and the only sectors that are heavily weighted in the indices that are not in downtrends are those that are in semiconductors, tech, communications. And that's going to favor the NASDAQ the most. The resilience above the 200 at the 200 exponential is going to be more so in the NASDAQ. So when I'm looking at the Russell, Randy, this is going to be one of my favorite corners of the broader averages to short the rip, to take advantage of movement lower. And so if weakness is going to get weaker and strength is going to get stronger, that favors the NAS. To the upside, it favors the Russell and frankly the Dow to the downside. Now, a lot of that is going to shift in Q1 because in Q1, we go right back to a little bit of bottom picking season where with an entire calendar in front of us and all the possibilities, we're not going to see money managers and money flow into things at higher highs, into things at the high of the year, into things that are already moving up. That's where the bargain hunting starts kicking in. So things like the Russell and the KRE and financials and healthcare and the Dow, those are going to get very tempting as we go into early next year. But right now, I'd focus on the downside. All right, Anthony, this morning the ES dropped from 41.99 to 41.87 and a half, now 41.93 within 20 minutes. Do I know it happened? Well, if it's a drop, first of all, is that a significant drop, right? That's always going to be my, first question. Is that a drop that's out of character for that symbol? And you might say, well, Rog, look at the size of the candles. Actually, what I'm going to look at, my friend, is the range, right? So there's your move right in there. And the way that I look at that is, did we exceed the typical price movement range for that hour in this symbol? And actually, Anthony, we did not. So this is, even though it's a sudden move relative to the moves, the candles that came before it, this is not outside the characteristic of typical volatility in the S&P. But as far as the timing goes, if I want to know potentially what might have affected the S&P at that time, there's a couple of things I can do. I can take a look at the different news sources that I have coming in. I don't make news in any way a timing element for me, but I do want to sometimes know, and it will be after the fact, whether or not something was said, done, released. It could have been any number of things. It could be geopolitical. Uh, it could have been data releases. Those are things that I'll look at. So if I know that the sell-off happened around 820, 825, I can go back and look and say, hey, we had some employment cost index numbers, right? And I don't know if there was a little bit of a jump ahead of that. What's weird about the timing isn't that we had volatility around 830. What's odd is that it happened before we got these employment cost index numbers. So I would say probably that. But I think the bigger answer is it was not outside typical volatility. Not really. Yeah. And if anything else, let me grab my drawing tools here. All right, where are they? There we go. If anything else, I think what's kind of cool is the resistance you'll see at the Darvis, right? Darvis, nail that Darvis with the Darvis signal. And oh yeah, hourly price movement ranges, but I thought I'd point out the Darvis. I tend to talk about my HPMRs a lot, but what else was in agreement, right? The Darvis, the automated support and resistance. All right, so let's see here. iPod asks, how will I game the 30-day window of tax loss selling then? I won't game it. I mean, I hear you. How do we play it? First of all, iPod, I think that for me, when I look back at October and I've got to be really frank about what I see, one of the hardest things to do as a trader is just look back on what you did and say, was that smart or not? Did I overlook things or not? And I probably underestimated the potential for certain bond funds, uh, regional banks, financials, healthcare, Russell. I probably underestimated how much tax loss harvesting would go on in some of these corners of the market that are down on 2023 or down year over year from October to October. So as far as my outlook for the remainder of the year, it's going to be the same thing. The very beginning of Q4, I start looking for what relative performance might look like. And actually, so far, that has panned out. So the thing that we've talked about in the rooms and I've put in top tier outlook is I'm looking for tech to be the most resilient, and it has. I'm also then looking for shorts in the Dow and the Russell. That's worked. What I would just expect more of that into the end of the year. But iPod, I'll tell you what else. I've been mostly focusing on day trading because in this environment of a lot of uncertainty and volatility, one of the best ways to capitalize on the lack of really easy to trade follow through. What do I mean by that? July, right? Think about how July looked and felt. So with a lack of that, one of the best ways to handle this environment, any environment like this, this is not unique to Q4 2023. You're going to run into situations, environments, trading activity like this throughout your career. Shortening the time frame is a really good way to do it. I will say also, full disclosure, yesterday was a tough day. It wasn't tough by way of the size of losses. It was tough by way of the follow through. Directionally, ultimately, we were on the right side. But as I mentioned, the journey to the target was untenable. So we take our losses as they're small losses and we say, look, this is not where the edges that I would typically look at, support, resistance, hourly price movement range. What's edge? Edge is where I think I have a distinct advantage based on what's being plotted on my screen. So I'm going to give it a go again, probably a little bit more conservatively in terms of what it is I'm going to set up when we day trade. And then I'd like to look for swings in the wake of probably Powell. I'm going to presume that whatever Powell says on tomorrow on the press conference, that he already has a pretty good idea. Let's be honest. He probably knows exactly what he's dealing with the non-farm payroll that was going to be released Friday. So most of his comments will probably already have baked in his knowing what that jobs number is going to be. All right. So RRC. Hey there, Ryan. Any thoughts on RRC on the daily? Yeah, I mean, it's one of those bullish names. I would keep an eye on some Darvis support, probably about 33.5. If you've got the 34 EMA wave, that's a great way to look at mean reversion. I don't think we're probably near a mean reversion. We might be not too far from one, but 33.5 to 33 might be a cool level from which to enter, where risk is probably pretty manageable. Again, the entries that we take are simply not based on we think the market's going higher or lower. Remember, the path to the target is actually trading. And the path sometimes is difficult to manage. And that's where I can look at a summit, right? I can look at the target and say, gosh, can I actually traverse the terrain to get there? And if the answer is no, there's no trade. And sometimes that terrain is different hot zones, earnings, Powell, jobs data, inflation data. And we say, wait a minute, while the target seems pretty clear, getting there might be tougher than it looks from, base camp looking up, So that's the way I look at that. But RRC, yeah, you at this point you're now 2 days removed from earnings. Probably a pretty good place to start looking for pullback buys. All right, GJ asks, do I know if any of my day traders trade just the 1 hour chart, not the 5, and trade the DPMR to DPMR? Do I know if any do? I mean, we do. That's short-term swing to me, right? So GJ, in the room, we do short-term swings. I wouldn't call it day trading, right? And actually, in our room, GJ, we don't try to identify as day traders, swing traders, investors, none of that, scalpers. What we remember is style, day trading, swing trading, scalping, investing, whatever, is like the numerous clubs in your golf bag or the numerous lures in your tackle box, where it's not about, I golf or I fish, I trade, right? And then I'm going to reach for the club or the lure that's best suited for what it is I'm trying to accomplish. So if daily price movement to daily price movement range on a 1 hour is something we can do, yeah, we do it. I think we did 3 of those last week, 1 hour DPMR setups. Is it something that is a really good way to go in this environment? Yes, I absolutely agree. But we're seeing a lot more volatility at the moment. But yeah, I mean, take a look at it yourself, right? I could say yes or no, but at the end of the day, proof's in the pudding. And so we are seeing a lot of adherence to those daily volatility zones. But I wouldn't worry about whether or not day traders are doing it. GJ, you can day trade and you can do this 1 hour thing, right? They're 2 different things that can coexist. Yeah. All right. Next up, thanks for the question, GJ. Thanks for asking about the DPMRs. I probably don't talk about them as much as I should. All right, BOP, I'd like to use your indicators and learn your trading style. Which simpler program would be best? BOP, for the collection of indicators that I would consider to be the foundation, and even access to a limited number of hourly price movement ranges included with your subscription, I would recommend the Sector Secrets Mastery, and you can check that out at sectorsecrets.com. And that would be the best way to look at, frankly, all things Raghee, which is that's what that room is. Sector Secrets is just the name of the service, but it really is the All Things Raghee room. I should go get allthingsraghee.com. But yes, that would be the best way to go. All right, Tesla. Tesla is probably one of the least magnificent of the Magnificent Seven if you're looking bullish, but it's probably, Siva, one of the most magnificent if you're looking for shorts within tech. I don't know that shorts within tech are something that I would necessarily prioritize. However, if you are looking for weakness within tech, and this is mostly your consumer discretionary sector, where Amazon and Tesla are number 1 and number 2, I would say if you're looking for shorts, Tesla would be it of the Magnificent Seven. If you're looking for buys, you probably want to stick with things like Meta and Microsoft and even NVIDIA. So this is where we think about our watch list as 2 lists, not just watching, but watching bullish and watching bearish. If your watch list is a set of names that you like, that's on a watch list. That's favorites list, and that's fine. But if we really want to get tuned into what the markets are doing, we think about relative performers. We want to find our best weakness stocks. We want to find our best strength stocks, and then we know directionally which way we want to trade either. All right. So as always, gang, thanks so much for being here for Charts and Coffee. I'll see you tomorrow, same time, same station. All right, gang. As always, be good to each other.